When we are considering all things expatriate here at LSR Partners, there are two main areas that we have to think about. The first is an individual's UK tax residence position, and that can change year on year. It's very much dependent upon where somebody is living, where they're spending their time. The second thing that we need to think about is something called domicile. And that's a longer term concept, and it's based upon where you consider your true home to be. For example, at the point you were told you've only got 6 months to live, where would you go? Would you go home, and would that be inside or outside of the UK? At the point when you pass away, where are you going to be buried? Where are your ashes going to be scattered? And usually that will give you the answer to where your domicile is. So for people who arrive in the UK to start off with, especially if they don't have any sort of right to remain in the UK, the likelihood is that they're not going to be considered domiciled in the UK. In terms of why that would be important, the starting point if you're a UK tax resident is that you're taxable on your worldwide income. If you're not domiciled in the UK, then you can elect for an alternative way of being taxed, and that is known as the remittance basis. What that means is that you're taxable in the UK on your UK sources of income as they arise, but on your overseas sources of income, you only pay tax to the extent that you physically bring it into the UK. And you'd pay tax at the point at which you bring that money into the UK. And this can work out very beneficially for those who are domiciled outside of the UK. In terms of the cost of the remittance basis, for the first 7 years that you're a UK tax resident, you would have to give up your personal allowance and also your annual exemption. Now, for a lot of people who might be thinking about using the remittance basis, you might find that actually their employment income levels are such that they don't have a personal allowance anyway. So really the only cost to claiming the remittance basis is the loss of an annual exemption, which is an allowance you get on capital gains. That's the first 7 years. Once you've been UK tax resident for 7 out of the previous 9 tax years, you would then start needing to pay something called a remittance basis charge, and that is £30,000 per year for years 8 to 12, and then that goes up to £60,000 per year for years 13 to 15. Once you've been in the UK for 16 tax years, HMRC will consider you deemed domicile, and the remittance basis will no longer be available to you. The pros of claiming the remittance basis is, as mentioned, you can kind of keep external income and gains outside the scope of UK taxes. The cons to claiming the remittance basis is if you do think that in the future you're going to need that income or gains and that money in the UK, then you're likely to create a future tax liability for yourself, and that's not always necessarily going to give you the best tax outcome overall. The other consideration, if you are looking at claiming the remittance basis, is that you then need to think about your bank account setup, because any income or gains you'd earned prior to your arrival in the UK would generally sit outside the scope of UK taxation. However, if it's mixed up with income and gains that you earned post arrival in the UK, it can unwittingly create UK tax liabilities. Now, that's the current way of being taxed for those who are domiciled outside of the UK, but HMRC, or the government in the budget, recently announced that those rules are going to change, and basically the remittance basis is going to be abolished, and what's going to be replacing it is something called the Foreign Income and Gain Scheme, or FIGS. What will be happening is from the 6th of April 2025, for those who are new arrivals to the UK, which means that you've been non-resident for at least 10 years prior to your arrival in the UK, for the first 4 years of UK tax residence, you won't have to pay any tax on any foreign earnings or foreign income and gains, whether or not that money is brought into the UK or left outside of the UK. Anybody kind of after those first 4 years of residence is effectively going to be subject to tax on their worldwide income. The government are aware that this might potentially create some challenges for those who are currently on the remittance basis scheme. And for those who are in their first 4 years of residence, they will transfer onto the Foreign Income and Gain Scheme. For those who are not eligible for this new scheme, whether that's because they haven't spent long enough outside of the UK or whether because they've been in the UK for longer than the 4 years, they have confirmed that there are going to be some transitional rules that might help to provide a little bit of relief to those impacted. So the first new rule, or the first transitional rule, is that for those who would otherwise be subject to the remittance basis, for that first tax year where they will be impacted by the rule changes, they will only be subject to tax on 50% of their foreign income and gains, thus providing a bit of an easing into this kind of full taxation. The second transitional rule is for anybody who's previously used the remittance basis and realised overseas income and gains that haven't been taxed because of this. Those income and gains are going to be able to be remitted to the UK during the 2025-26 and 2026-27 UK tax years, and they will be subject to a flat tax rate of 12%, irrelevant of what they should have been in the first instance. So that could be a really good planning opportunity for those who have money outside of the UK that they are thinking of bringing in. The other transitional rule for people who have assets that they've owned before the 6th of April 2019, for them HMRC are offering the ability to rebase the value of capital assets that would otherwise be subject to capital gains tax to the value that it was at the 5th of April 2019. There's also some complications associated with offshore trusts, which are going to come potentially within the scope of UK tax. So for any income and gains that would otherwise have been sheltered, they will remain sheltered until the 5th of April 2025. And the only tax implications on those would be if there are distributions made, but thereafter further foreign income and gains would be subject to tax. If you need any help planning for these changes, then please do get in touch.